If you're an adult in these here United States, you probably have a credit score. And you've probably been told, maybe more than once, to live your life in such a way that will improve that strange number that lies somewhere between 300 and 850. Build good credit, you're told, and financial success will follow. The higher your credit score, the happier and more secure you will be. That is not a wholly irrational belief. Credit scores have a pervasive, though often invisible, set of impacts on our lives. They are everywhere today. They're often required for renting an apartment, for getting a mortgage, for taking out a loan, even for getting a job. But for a number so important, it can be remarkably arbitrary. You've probably experienced just how capricious and downright weird your credit score can be. Pay off a loan, do the responsible thing, and your credit score may go down, not up. But maintain multiple credit cards, use them frequently, and continually pay installment loans, your credit score is likely to increase as long as you never miss a payment. It is a very strange system. Now, believe it or not, it wasn't always like this. This peculiar practice where a score is so powerful in determining so many aspects of your life wasn't always around. In fact, credit scores, also known as FICO scores after the company that created them, weren't used to determine loan pricing until 1989. That's not that long ago. How did it get this way? How did we come to a point where this funny little number exerts so much power over our daily lives? To understand, we'll have to go back a bit, to a time called the 1970s. It was the age of bell-bottom jeans and disco, and Gerald Ford, God bless him, and Dog Day Afternoon. Not just Al Pacino, but John Cazale and Charles Durning. Attica. Oh, love that movie. But the 1970s was also a time when American industry was getting rapidly automated and outsourced. And a lot of people who had previously made a pretty good living began to lose out. Throughout the 70s and going into the 80s, 90s, and the aughts, industries like steel production or auto manufacturing rapidly shed their workers. And places like Youngstown or Flint or Warren, Ohio, that's my dad's hometown, were left without a whole lot of support. Manufacturing fell from more than 30% of total employment in 1955 down to 22% in 1975, and then less than 19% by 1985. By 2005, it had fallen to just barely above 10% of the total jobs in this country. For the most part, these high-wage industrial jobs with good pensions and benefits were replaced by jobs in the growing service sector. A lot of people in our great national industrial belt wound up working at places like Walmart or McDonald's, which provided no benefits or pension and wages a lot lower than what people were previously making. At the same time as this process of deindustrialization was unfolding, a new philosophy was on the rise in government. It was an attitude that prioritized belt-tightening, austerity, deregulation, an approach that was called neoliberalism. As many unemployed or underemployed workers grew into a surplus population on the margins of the economy, political elites slashed welfare programs while deregulating the industries like banking. And in 1978, the Supreme Court prevented states from enforcing laws capping interest rates for nationally chartered banks, gutting anti-usury protections for lenders. So, the 1970s saw two important trends. First, deindustrialization and falling living standards in much of the United States. And second, the deregulation of banking and lending. In the 1980s, these two trends would collide. You see, with the new glut of households that were dependent on low-wage, no-benefit jobs, people could no longer survive just on their incomes, as they might have been able to before. So they had to turn to the exciting new world of consumer credit, and debt became a bigger and bigger part of working-class life. This led to what the scholar Suzanne Soderberg calls debt fare. Consumer debt as a substitute for good jobs and good wages and a social safety net. Now, of course, debt has been around for a very long time. It was already widely used in the United States to finance big-ticket purchases like cars or college. But as wages collapsed and welfare programs were cut, more and more families were forced to go deeply into debt just to stay afloat. The cold, hard reality was that people just couldn't live on what they earned and were constantly on a treadmill of debt in order to provide for their families. In the 1980s, banks learned how to take advantage of this situation. Before, the credit cards they offered were a loss leader for them. But then they realized something important. The way to make money was not to target people who were well off and could pay off their debt. No, it was to target people who were not well off, who were reliant on debt and who could not pay it all off at once. As one banker said in an interview, and I quote, "It didn't require a lot of investigation to see that the people who paid their debt in full every month were not profitable." Banks called these customers revolvers, people who took on the maximal amount of debt they could without defaulting and who could be charged higher interest rates as a result. Overwhelmingly, of course, these revolvers were living paycheck to paycheck, who needed debt in order to get by in the harsh new economy. They became the target, really the prey, for an explosion in consumer lending, with the plastic credit card at its center. The banks pitched it as a matter of freedom and flexibility, but for the downwardly mobile people who were targeted, it was about necessity. The massive expansion of consumer lending is where the credit score came in. You see, lenders had long employed ways to discern how creditworthy their applicants were, with arbitrary judgments of whether they were shifty or of good character. But as corporations amassed huge reams of information on customers and their behavior, they now had enough computerized information for them to cook up algorithms about who was and who was not creditworthy. So in 1975, the first FICO score was developed. But the banks weren't so interested in trustworthy or creditworthy lenders. No, they wanted those revolvers, the people who would make them as much money as possible. And when the first general purpose FICO score came out in 1989, that's what it was designed around. Which is why, in 1995, the director of consumer policy at Experian, one of the biggest credit rating agencies, admitted, "Modeling just credit risk is passé. The real risk is that a customer is not profitable." They were searching for what one banking publication called debt-prone consumers, and systematically targeting working-class people who now needed debt in order to survive, and who could be charged higher and higher interest rates as a result. So starting in the 1980s, lending to the poor, so-called subprime or non-prime lending, grew rapidly. The riskier the borrowers were, the more interest they could be charged, and the more money the bank could make off them. That's why at Wells Fargo, one of the biggest banks in America, loan officers were incentivized for years to aggressively market subprime loans to Black communities, even for people who qualified for prime loans at lower interest rates. These victims were the profitable customers the banks were looking for. Wells Fargo called these ghetto loans, and loan officers referred to the individuals they were trapping in debt as mud people. Ugh. The goal, of course, was never to help them. It was to make money off them through predatory lending. The credit score became a crucial part of this. It's a tool of discipline that makes you into the ideal customer for the banks. That's why credit scores don't reflect actual financial health. Things like the difference between your income and your spending or how much money you've saved. What they do reflect is you being a reliable, juicy profit source for them. They're not looking for trustworthy borrowers. They're looking for people who can be counted on to live in debt, because keeping you in debt means profit. Your credit score rewards you not for making decisions that actually help you financially, but for taking on the maximum amount of debt that you can possibly repay. In an economy as unequal and predatory as ours, credit scores may be necessary in the narrow sense of what our system demands. But credit scores and the entire system of debt that lies underneath them are not a fact of nature. They're not something eternal, like the thespian artistry of Al Pacino. Credit scores are necessary only in an economy that cannibalizes the hard work, sweat, and tears of its working people, that regulates so much of our lives through a number reflecting your utility to the banking industry. You can spend your whole life working on that number, and many of you will. But no matter how high you get that score, no matter how many years of work and sacrifice you spend, you will have already paid the price. I'm Chase Madar, Wandering Law Professor for the Gravel Institute.